Hello everyone, I hope you're all doing fine. I welcome you to the second session of IAS 16 Property, Plant and Equipment, where we are going to be discussing on depreciation today. This session is going to start from the basics of depreciation, and we will be discussing about the kinds of the methods that are used by the entity to calculate depreciation, and at the end we are going to be discussing some questions. We'll be doing them together, which is going to further enhance our understanding on this area. Now, in the previous session, we had talked about the initial recognition of assets, where we had talked about how the entity recognizes the asset under IAS 16. Now, once the entity recognizes the asset in their books, subsequently they have to make a charge against that asset, which is known as depreciation. Depreciation, basically, in very simple terms, is a charge that is made to assets value to reflect its usage over time. That is what depreciation means. It's a charge, which means it reduces the value of the assets with the passage of time. Okay, it's going to reduce the value of the asset in your books as the time is going to pass. But why is depreciation going to reduce the value of your assets? So just like I have told you now, that it is a systematic allocation of the cost of a non-current asset over its useful life. Basically, it's a way that we are going to be distributing the cost of the asset over its useful life. This ensures that the cost of using an asset is matched with the revenue it helps generate in line with the accrual assumption. Now, when an entity is going to buy an asset, a non-current asset that is going to be held under IAS 16, the entity is not going to make that entire charge of the purchase to profit or loss. So if an entity has made a purchase of an asset, it is not going to recognize that purchase as expense in the profit or loss. It is going to capitalize that amount, recognize that as non-current asset, and record it in the books. This is what we have discussed in the previous session, right? But what happens is, with the passage of time, because that asset is going to help generate revenue, right? Because this was one of the recognition criteria of the asset, that it should help you generate economic benefits, right? So as the asset generates economic benefits, what you do is you charge the depreciation to that asset with the intention of matching that charge with the revenue that the asset has generated for you. And we know that this is going to happen under accrual assumption, all right? Because accrual assumption essentially is a matching concept, which ensures that expenses are recorded in the same period as the revenue they help generate. Because, for example, if an entity is going to buy an asset that is worth $100,000, it would absolutely be not sensible to make this 100,000 sit in the profit or loss as an expense in that particular period. The entity will recognize this as an asset in the statement of financial position, and then will charge depreciation every year to reflect the use of the asset in terms of generating economic benefits for the entity. So that is what the depreciation does for the asset. And it is extremely important that an entity charges depreciation, because according to the accrual assumption, we must be matching the expenses with the revenue they help generate for that particular period. All right. So in context of depreciation, when a business purchases a non-current asset, it does not expense the cost immediately. Instead, the cost is allocated over the asset's useful life through depreciation. And what is the useful life? It is basically the period for which the asset generates economic benefits. That is what the useful life is going to be. Because once you purchase an asset, for example, if I've purchased an asset today, I cannot expense this 100,000 in my P&L, because I haven't realized the economic benefits of the asset in one day. It is not sensible for me to say that this 100,000 should go and sit in P&L. It should not, because you should ask yourself, have I realized all the benefits from that asset today that I should go and charge this as an expense in the P&L? No. What you do is, because the asset is going to help you generate future economic benefits, you take the value of the asset. So if it is 100,000, this is the value of the non-current asset, and you will divide it over its useful life, which is the period for which the asset is going to generate economic benefits for you, and you will distribute this cost across these years. So basically, this is going to give you $10,000. This is the depreciation charge which will be made every single year to the profit or loss statement. Because why are we taking this charge? Because we are matching it with the revenue it helped us generate every single year. So this ensures that each period bears a fair share of the asset's cost, matching it with the revenue it helps generate. All right, I hope that is clear. Let's move on. A depreciation expense is recorded in the income statement to reflect the usage of the asset, reducing the business's profits accordingly. All right, so you do not go and charge $100,000 in the P&L today, which is basically is going to generate a loss for you. If I go, rather than charging 10,000 at the end of the year, I go and charge 100,000 today because I just purchased an asset, it's obviously going to generate a loss for me. So what I'm going to do, I will have a very systematic allocation of the cost of the asset, so that I can, based upon the accrual assumption, have my business profits reduced in a proper systematic manner. Okay, so there are some key terms that you should be familiar with. Depreciation is the allocation of the depreciable amount, which we will also discuss what do we mean by depreciable amount, of an asset over its estimated useful life. Useful life is the period over which an asset is expected to be used. So for that particular period of time, it will generate economic benefits for you, or the number of the production units expected from it, because useful life means that the period of life for which it is going to be useful for you, for the business. Depreciable amount is the asset's cost, or the revalued amount minus its residual value. So we are going to see now the kinds of the methods used to calculate depreciation, but depreciable amount is simply the amount of the asset that is going to be used to charge or calculate the depreciation. So it's the value of the asset which we are going to be using to calculate the depreciation charge every single year. Residual value is the estimated amount the asset will be worth at the end of its useful life, because it's going to have some resale value. We will have some resale value expected at the end of its useful life. That is known as the residual value, the scrap value, that the value at which you can get rid of that asset at the end of its useful life. Now let's look at the methods of depreciation. IAS 16 allows two main methods. One of this method is known as straight line method. Under this method, the depreciation expense remains the same each year, make it ideal for assets that wear out evenly, such as office fixtures and fittings. So basically what happens is, when a business is going to purchase an asset, and any kind of asset, for example, now each kind of assets may have its own nature in generating economic benefits for the entity. You might see some of the assets are going to generate higher economic benefits for you in their early years, and some are going to be generating evenly up until their useful life ends. There are going to be some of the assets that are going to be more useful to you at the very start of the year, whereas some assets are going to be useful equally across all the years. Straight line method is going to give you the depreciation charge, which is going to be same every year. It's a constant depreciation charge. If we follow straight line method, it gives us constant depreciation charge, and it is going to be suitable for those kinds of assets that are going to give us constant economic benefits every single year, such as office fixtures and fittings. If, for example, based upon the judgment of the entity, we think that this particular asset is going to give us constant economic benefits, which means same level of economic benefits every single year. We will then select straight line method, which will give a constant depreciation charge every single year. Constant means same depreciation charge every single year. For that purpose, you will use the formula as cost of an asset, all right, minus the residual value. So from the cost of an asset, you will deduct residual value, and you will divide this by the expected useful life. Why are we dividing? We are dividing to spread the depreciable amount across its useful life. This cost of asset minus residual value is known as depreciable amount, because this amount is going to be the amount that is going to be subject to depreciation. Or you could have one formula as this, okay, cost of asset minus residual value divided by expected useful life. And you could even have the other one where you will have cost minus residual value multiplied by the percentage. So you might sometimes be given percentage of depreciation, and you will simply apply that percentage of depreciation to the depreciable amount, and you will get how much the depreciation charge should be every single year. Now the next question you could think is that why do we deduct residual value in straight line method? What is the need to deduct the residual value? This is cost of asset minus residual value. We have just said that this is a depreciable amount that is going to be spread across the life of the asset. Okay, this is the amount that is going to be spread across the life of the asset. But why are we not simply taking the cost of the asset and spreading it? Why are we deducting the residual life? Depreciation only applies to the portion of the asset's cost that will be used up over its useful life. Used up in what sense? Used up in generating economic benefits for the entity. We are going to consume that portion of the cost over its useful life. Depreciation reflects the asset's wear and tear and obsolescence, which basically means that it is going to be reflecting the usage of the asset with the passage of time. All right, since the company expects to sell or scrap the assets for its residual value at the end of its useful life, the portion is not part of the depreciable cost, which means that we are deducting the residual value because we do not want this value to be spread across the useful life of the asset. Let's just keep it aside. The reason why we're deducting residual value, we want to keep that aside. Take out the value, the scrap value out of the cost of the asset. Whatever you have remaining will be spread across the useful life of the asset to calculate the depreciation. So that is the reason why we deduct the residual value, because we should only be able to allocate the part of the asset that loses value over the time. Residual value, we want to keep it preserved because this is the value at which we would want to sell the asset at the end of its useful life. The remaining of the value of the asset is what is going to be consumed by the entity over the useful life. So if we didn't deduct the residual value, what will happen is that we'd be overstating the depreciation, which would lead to understating profit and misleading the financial statements. Because if we do not deduct the residual value, that depreciation charge would essentially also include the consumption of the residual value. We do not want this residual value to be consumed as we are calculating the depreciation. We want to keep the residual value separate, all right, and then just take whatever is left and spread it across the remaining life of the asset. So for example, if I have an asset worth $100,000, all right, so this is the cost of the asset, and the residual value of the asset is going to be 20,000, which means that at the end of the asset's useful life, I'm expecting that it will be sold at 20,000. Now you must understand that depreciation is a charge that is done against the asset in order to reflect the consumption of the value of the asset with the passage of time. And how do we consume this value? Because the asset is going to generate the economic benefit, right? So we are consuming the value of the asset for our own benefit. Whereas this residual value, it essentially means that this is the value I'm expecting that the asset will have at the end of its useful life. After I have consumed everything from the asset will now have the value of 20,000 at the end, and this is the value at which exactly I'm going to be selling the asset. So essentially 20,000 is the value that I'm not going to consume, right? So don't you think that it makes sense that I should be deducting this 20,000 to finally get that amount which I will be consuming from the asset? Consuming in the form of generating economic benefit, against which then I will charge the depreciation as per the accrual concept. So that is the reason why we deduct the residual value, right? So let's move on and try to do example. If this session you're taking for revision purposes, I will recommend you to stop the video right now and try to do it on your own before then playing the video and try to match your answers and see how much of this you got it right. So a company purchases machinery for 60,000 on January 1st of 2024. So 60,000 is the cost of the asset. The residual value is estimated to be 10,000 and the useful life is 5 years. Calculate the annual depreciation expense using the straight line method. And we have already studied just now what is the formula. I will recommend you to learn this formula. All right, the formula which we have discussed now, where is it? This formula. I'm just going to clean this up a little bit more. This formula, please learn this, okay? Because this is going to be applicable when we'll be talking about the straight line method. So please learn this formula. So once you've learned this formula, this is how you will calculate the depreciation charge. You will take the cost of an asset minus the residual value, and you will divide all of this by the useful life to get the depreciation charge per year. So that's going to be 60,000 minus the 10,000, because 10,000 is the value of the asset which we will not be consuming, and then divide this by 5. This should give you 10,000 of the depreciation charge every single year. All right. So 10,000 is the depreciation charge we will be charging every single year until the time period of the 5 years completes. So determine the book value at the end of the year 3. Book value is also known as carrying value of the asset. Book value is also known as the carrying value of the asset. So what is going to be the book value? Depreciation is going to be charged per year is going to be 10,000, right? So if there are 3 years, which it says at the end of the year 3, so the depreciation charge will be as follows. The total depreciation charge would be 3 years multiplied by a depreciation charge of 10,000 per year, and the total depreciation charge would be 30,000. The total depreciation charge will be 30,000, which is going to be reflecting the usage of the asset in the business. And book value basically means the value of the asset in that particular period of time that is going to be reflecting the deduction, right? Because of depreciation. So which means the carrying value will be the initial cost, which is going to be 60,000, all right, and minus the 30,000. Minus the 30,000, this should give you the carrying value as 30,000. So at the end of year 3, in statement of financial position, under non-current assets, this is the carrying value of the asset which you will be seeing. All right. We have another question, and I will recommend you to take a break. Try to do this on your own, because the only thing different is that we have a depreciation rate given to us and the rest of the things are same. A company buys office equipment for 50,000 on January 1st. The asset has a residual value of 5,000 and a depreciation rate of 20% per year, which is based on the straight line method. Confirm the annual depreciation expense using the percentage method. And it's very simple. Let's just speed it up. The charge is going to be as follows. You have the cost of 50,000 and you will deduct the 5,000 of the residual value. Once you do that, whatever answer you obtain, you will put 20% charge on this. So put this into your calculator. You must find out that the depreciation charge is going to be 9,000 every year. This is going to be 9,000 per year of the depreciation. and determine the book value, which is going to be the carrying value at the end of the year 2, which means that if we are talking about the total depreciation at the end of the year 2, which will be simply as total number of the years, which is 2 multiplied by 9,000 per year, which is going to be the depreciation charge per year. 2 nines is 18. You have 18,000 as total depreciation. Therefore, the carrying value of the asset will be the initial cost, all right, minus the total depreciation. This is what the carrying value of the asset will be. So if we look at this, the initial cost is 50,000 and you will take away the total depreciation, which is 18,000. So under non-current assets in statement of financial position, the value of the asset at the end of the year 2 will be 32,000. This is how you will go about calculating the depreciation. The reason why we calculate the total depreciation for the year 2 is because we are going to be accounting for the depreciation charge for 2 years. All right, so in total we are going to be talking about 2 years, and then we are going to simply deduct the total depreciation of 2 years from the initial cost, which is going to give us finally the cost of the asset under statement of financial position at the end of year 2. I hope this was clear. In the exam, you may get the percentage basis or you may get straight line method basis. It's going to be the same. There is nothing different except that you have to apply the percentage if you come across this method. But the point of straight line method is that the depreciation charge is going to be same every single year. That is the reason why when I was calculating total depreciation for 2 years, I had simply picked up the depreciation charge per year and simply had multiplied this by the number of the years. This is the benefit of the straight line method, is that the depreciation charge is going to be same every single year. And when you calculate the carrying value, you will simply take that value at which you had initially recognized the asset minus the total depreciation. So whether it's just for 1 year, 2 years, 5 years, 10 years, or 20 years, you will get the carrying value you will have at the end of that specific time period that is relevant to your question. That is straight line. Let's move on to reducing balance method. Reducing balance method is simply the method that is used for assets that generate more revenue in the early years, such as machinery. The depreciation charge is higher in the initial year and decreases over the passage of time. As we have already discussed this, the depreciation is a method to match the revenue that the asset generates with the expense of utilizing the asset, which is wear and tear. So if in the initial years of the asset, the wear and tear is higher, which means that we are consuming more of the asset, don't you think that there should be a method that is going to give us higher depreciation charge in the start of the years, a higher wear and tear charge? This is exactly what reducing balance method does. So for those assets that are going to be giving you many more economic benefits at the start of the years, like in the first maybe 5-6 years, reducing balance method ensures that we have a higher depreciation charge in those years, which is going to be matching systematically with the higher economic benefits that those assets generate at the start of the years. And the formula is simple. You have net book value, whatever it is, either it is the cost or it is going to be the book value at the end of any particular year, multiplied by the depreciation rate, where net book value is cost minus the accumulated depreciation. Accumulated depreciation, in simpler terms, means piled up depreciation. So basically it means that if we are talking about at the end of the year 2, you will take the depreciation charge for 2 years. If you're talking about the net book value at the end of 5 years, you will take depreciation charge of 5 years. This cost is the initial cost, which is the cost at the very start when we purchase the asset minus accumulated depreciation, all the depreciation that has piled up for that particular asset. All right, so if we are talking about the net book value at the end of 5 years, then what we do is we take the initial cost, which is the cost that we recognized at the very start, and then what we do is we take the depreciation that is worth of 5 years. 5 years worth of depreciation, and 5 years worth of depreciation we deduct and we get the net book value or the carrying value of the asset. When we hear the word carrying value, it simply means the value of the asset which has incorporated the effect of depreciation. All right. So accumulated depreciation means piled up depreciation. This method ignores residual value. Why? We were worrying about a residual value in the straight line method because we were essentially talking about the value of the asset which we are not going to consume in the form of economic benefits. Then why is residual value ignored in reducing balance method? Reducing balance method applies a fixed percentage to the net book value each year. This basically means that whatever the net book value will be, you will apply the depreciation rate. It could be 10%, 20%, or 30%. You will apply to the net book value, whatever it will be. And then once you apply the percentage, put that into your calculator, and whatever you get is going to be your depreciation charge for that particular year. Notice how I'm saying depreciation charge for that particular year. I'm not talking about straight line where the depreciation was same every single year. Depreciation under reducing balance method is not same every single year because of the nature of the assets which produce higher economic benefits at the start of the years. So we usually have higher depreciation charge in those start of the years, and the depreciation gradually goes down and down and down. And we are going to see this practically through an example right now, but just to get an idea, under reducing balance method, the depreciation charge per year is not same. So what we do is we apply a fixed percentage to the net book value, which automatically ensures that the depreciation never brings the asset below its residual value. Because if the value of the asset goes below its residual value, it will not make sense. Because this is what we had decided when we bought the asset, that this is the scrap value, the resale value at which the asset will be sold. And if the depreciation charge makes it go below its residual value, this will not give a relevant representation of the assets in your accounts. So you must then take a step back and then think, what am I doing with the asset valuation, right? It means there is something wrong with the methods that you have selected for your assets. Depreciation in the final years is adjusted to ensure the asset's book value equals the residual value, and that the book value of an asset in the final year does not drop below its residual value. Because you must ensure, whether you charge straight line or whether you charge reducing balance, once the depreciation eats away all the cost of an asset, that from where you utilize the economic benefit, the value of the asset at the end should be equal to the residual value. It should not be more, it should not be less. If it comes out to be more or less, then you did something wrong. Once we have utilized the economic benefits from the asset, at the end of its life, the value of the asset must equal to the residual value. Is that clear? This will be further understood through the help of an example. Asset costs 100,000 and has a residual value of 10,000 and a useful life of 5 years. Calculate the depreciation under straight line method. So if you're someone who is new to this concept, I will always recommend you to write the full formula so that you get more and more familiar with it. So this is going to be cost, which is 100,000, minus the residual value of 10,000, and then you will divide this by the useful life. So with this, you should find out that the charge every single year is going to be $18,000. This is going to be the charge every single year of the depreciation. And you will do this every single year. It's going to remain the same. It's not going to change. This is what we mean by straight line method. But reducing balance method is a little funny. Specifically, what happens at the end of the year. As you can see, I have drawn a table for you because that is how we are going to be calculating the depreciation under reducing balance method. So as you can see, I have drawn out a table for you because that is how we are going to be calculating depreciation under reducing balance method. In the first column, we have year, which is going to be basically the year for which we're calculating the carrying value or the depreciation. So we are going to be listing that as year 1. Then we have opening balance, which is simply the value of the asset at the very start of the year. All right, at the very start of the year, what is the value? Then we have depreciation charge, which is 30%. So depreciation will be charged for that one full year, right? So this we have year 1. Opening balance is going to be 100,000. 100,000 is the opening balance. Depreciation is 30%. What is 30% of 100,000? 30% of 100,000 is 30,000, and we know that depreciation reduces the value of the asset, so you will deduct this depreciation, and the carrying value of the asset at the end of the first year is going to be $70,000, which is also known as the closing balance. Closing balance means the balance on the asset at the end of the year. Opening balance, on the other hand, means the balance of the asset at the very start of the year, the value of the asset at the very start of the year, right? This is going to be the carrying value of the asset, which will be reflected in statement of financial position at the end of the first year. Then we go on to the second year. The thing different about the reducing balance method is that you will carry forward this closing balance as the next year's opening balance of 70,000, and you will charge 30% on 70,000. So when you charge 30% on 70,000, you will see that it comes out to be $21,000. This is the depreciation charge, and then when you deduct depreciation from this value of the asset, you will come to know that it will give you 49,000. This is going to be the carrying value, the closing balance on the asset at the end of year 2. And then you repeat the process. You do 49,000, you carry forward that balance, 49,000, you will take 30% of 49,000, which will be 14,700, and then you will deduct in order to know the carrying value at the end of the year, which will be 34,300. Now try to do year 4 by yourself. If you decide to do that, this is how it should look like. 34,300 will be carried forward as the value of the asset at the start of the year, and then you will charge 30%, which is going to be 10,290. This is going to be reducing the value of the asset. So 34,300 minus the depreciation charge of 10,290, you should find out that the value of the asset at the end of the year 4 would be $24,010. Now let's talk about year 5. This is going to be a very special year because this is the year at which the asset is going to be disposed of. This is the year in which we are going to be discarding the asset because the useful life is going to be completed at the end of this year. So you will carry forward the value of the asset as $24,010. But notice how if I take 30% depreciation of this amount, I should find that it comes to $7,203. And as usual, if I take away this depreciation from the value of the asset, I will get the value of the asset at the end of the year as $16,807. But notice how the residual value is $10,000. Why am I having a higher residual value? Which means this is wrong, right? Because the value of the asset at the end of the year 5 should be 10,000, because this is the value of the asset at which I'm expecting it to be disposed of. I'm going to sell the asset at this value, but it is having 16,807 at the year end, which means we are not going to be following the percentage method at the end of the year 5. What we will essentially do is we will put this 10,000 here, all right, and then we will calculate this as a balancing figure. How will we calculate this? So essentially we have to think about that what should be the depreciation charge that when deducted from the opening balance it gives us $10,000. This will be simply calculated as $24,010 minus the $10,000. It gives us 14,010. This is the final depreciation charge at the year end. So I hope it is clear that what we do at the end of the year of its useful life is that rather than charging the depreciation percentage of the balance at the start of the year, what we do is we take the difference between the opening balance and the residual value, and that particular difference is going to be the depreciation charge, which will be sitting in the statement of profit or loss for that particular year. Because what we are trying to do here is to bring the value of the asset equal to its residual value, because as we saw before, that if we apply the percentage on the opening balance, then our closing balance will not be equal to the residual value. So this is what is known as adjustment that we do at the end of the useful life. In the reducing balance method, it's extremely crucial that we do this adjustment so that the value of the asset at the end of its useful life matches its residual value. All right, this is the difference. As we can see that the depreciation under reducing balance is charged highly at the start of the year, with the exception of the adjustment that we do at the end of the useful life. But you can see the trend that there is a high depreciation charge at the start of the year, and the depreciation charge progressively gets lower and lower as the time passes. But in the straight line method, it is going to stay constant. It is going to be 18,000 every single year. All right, let's move on to now discuss the double entry for depreciation, which is going to be the debits and the credits we should be knowing. Depreciation has a dual impact. It reduces the asset's carrying value in the statement of financial position, which we have seen here that it does. As you can see that the depreciation was reducing the value of the asset at the start of the year. So the closing value of the asset was 70,000. So here we saw that the depreciation reduced the value of the asset during the year, and at the end of the year we had a closing balance of 49,000. All right, so depreciation reduces the value of the asset in the statement of financial position, and it is also recorded as an expense in the income statement. So depreciation basically goes to two places: statement of financial position and statement of profit or loss. It goes to statement of financial position to reduce the value of the asset. All right, to reduce the value of the asset, and it is also going to statement of profit or loss to be recorded as expense. It is also recorded as expense. But if you're familiar with the presentation of financial statements, then you can question that when you see non-current assets in statement of financial position, you do not see depreciation anywhere. You directly see the non-current asset balance, right? Which is true, because we never show depreciation on statement of financial position. We always show the final book value, the final carrying value of the asset. But basically this depreciation essentially also goes to reduce the value of the asset that is sitting in your statement of financial position. There is a difference. Depreciation is presented as an expense in the statement of profit or loss, but what it does in statement of financial position is simply it goes and it reduces the value of the asset. It does not stay there. It does not sit in the face of statement of financial position. It just simply reduces the value of the asset, and then from there it goes to statement of profit or loss. So you can think of it this way. What does the depreciation do? Depreciation first visits statement of financial position, where it eats the value of the asset, and then after it visits, has a nice time with the asset, it then goes to statement of profit or loss, where it goes, relax and sits, and is always shown on the face of the statement of profit or loss. All right, so you can think of it in this way. Therefore, the journal entry is going to be debit depreciation expense, which is going to be on the income statement, because expenses always have a debit entry, and credit accumulated depreciation, statement of financial position. Accumulated depreciation, as I told you, on the other hand, is also known as piled up depreciation. But if you are talking about the depreciation at the start of the year, then it is simply equal to the depreciation charge during the year. All right, so what it does is, when you charge the depreciation expense during the year, that particular charge is going to go to the statement of profit or loss in that particular period, right? But credit accumulated depreciation means then it also forms a part of the piled up depreciation, which is going to be reflected in the statement of financial position as a deduction from the value of the asset, which we have just seen here. Depreciation will go, it will spend time with the asset, it will reduce the value of the asset, and then from there it will walk and will go to statement of profit or loss. All right, where it will relax and where it will sit. So credit accumulated depreciation means it will be eating away the value of the asset. Now, very important tip that I will give you, that why is it a credit? One factor is assets always have a debit balance. Okay, all assets always have a debit balance. In statement of financial position, when you see the value of the assets, they're all debit balances. So when you do credit, when you credit something, if you credit something against the debit, you must know that on the other hand, or in simpler words, it means that credit is going to reduce the debit. All right, when you credit something against the debit, it reduces the debit. All right, so when you say debit assets and credit accumulated depreciation, what essentially it means that we are reducing the value of the asset. So this credit balance is going to go to the debit balance and it will eat it away. So the assets are sitting as debit, the depreciation goes there as credit, and it eats away, and then it goes to the statement of profit or loss. So that is the reason why it's a credit balance, credit accumulated depreciation, because this is a deduction to the debit balances of the asset in the statement of financial position. There are some additional considerations. The depreciation starts when the asset is going to be ready for use, not when it is actually used. So you may have constructed a machinery. For example, you have constructed a machinery during the year, and that machinery is sitting in your warehouse, in your storage facility, and you haven't started using it yet. You might put forward this argument that because I'm not using it, I'm not obtaining any economic benefit, so why are you telling me to start charging depreciation? But IAS 16 says that, look, even if you have the asset not in use, you must start charging depreciation when the asset is ready for use. So even if you have the asset which is not being used currently, but it is ready to be used and it is sitting in your storage facility or warehouse or wherever, you must start charging depreciation on that asset, not when it is actually used. So you can say that I have an asset sitting in my warehouse right now, but I'm going to start using the asset next year. You will start charging depreciation right now, not next year. Changes in depreciation estimates are applied prospectively, meaning the new estimate is used for future calculations. We will be looking at these types of calculations in the future, but what it means is because it is going to be dependent upon the entity's judgment to decide whether we are going to go for straight line or for reducing balance method. Sometimes it happens that the entity might change their mind and they might think that, okay, this is not going to go for reducing balance, rather the asset is going to follow more of the straight line trend. So when the entity decides to do that, from that point of decision and onwards, you will only apply that policy which you decide. So for example, if you're going from reducing balance to straight line, then at the point of decision and onwards, you will take that value and of the asset and subsequently apply straight line method. You will not make any changes in the past. If in the past it was sitting at reducing balance, you will keep on making it sit in the reducing balance. You will not go in the past and you will not change any numbers. But in the future, based upon your decision, whatever will happen on the straight line basis. If an asset consists of separate components with different useful lives, each part should be depreciated separately because they are going to be providing separate economic benefits for you. So for example, in aircrafts, you might see the engines are going to be having different useful lives. Then the other components of the airplane may have different useful lives because they will need replacement at different part of the airplane's total life. All right, so you will not incorporate and charge depreciation altogether, rather you will separate the components out and will charge depreciation separately. In this way, you will have a more true reflection of the value of the assets. Useful life and residual value must be reviewed at least annually. Why are we going to review it? Just to check, for example, if there is any change in the useful life of the asset, or maybe change in the residual value of the asset. If there is any change that happens, then we can reflect this into our own calculations as well, so that we can ensure that we are reflecting the true value of the assets with the